Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Happy Coast Guard Day, everyone, which was founded by one Alexander Hamilton. Not sure that was in the play, was it? On August 4th, 1790. And speaking of singing statesmen, we're maybe going to get Ben Eifert on here sometime soon. It's like scheduling the actual dead Hamilton at times. Hard. Plus, we have Augustin LeBron, a tail hedge manager, and institutional vault trader all coming up over the next couple weeks. On to this episode, which we hacked from a recent Lunch and Learn webinar I hosted with Auspice Capital's founder and CIO, Tim Pickering. He dished the education on commodities, trend following, oil, fertilizer, volatility, and much more. And I was there to ask some questions of my own, plus some audience questions, which meant, yeah, this is going to be a podcast too. Send it. This episode is brought to you by the aforementioned Lunch and Learn series by RCM and co-sponsor CME Group. We do about one a month and have mutual fund and private hedge fund managers do a virtual lunch with advisors and investors in a casual, small setting where questions are welcome. Follow us on Twitter at RCM Alts or LinkedIn to catch news of the next one. And we give out Grubhub gift certificates. So yeah, go give our Twitter a follow to get a free lunch on RCM next time around. And now back to the show. Welcome, Tim. How are you?
Good. How are you?
I'm pretty good, thanks. I'll turn it over to Tim to introduce himself and Auspice, and then we can get started.
Yeah, well, high level. Auspice has been around since 2005, launched by myself and Ken Corner. Ken and I have been trading virtually side by side since around 2000, so 22 plus years. Both at Shell, where I brought him in to help support the trading business I was running, and then both had stops at TD Bank, and then launched Auspice. The idea behind Auspice was take that quantitative skill set I'd started at TD Bank and took to a different level at Shell. Obviously focused a little bit more on the commodity side, energy specifically, and felt we had a unique experience set and a unique strategy that was applicable beyond energies and beyond commodities, and we wanted to expand that, which obviously didn't really fit the Shell world. And we started that in 2005. First fund launched in late 06. One of the things we did different was while we were building up that track record, we felt the ETF space was going to be an interesting one. And we went into the ETF space very early, first with a very simple product, a beta like ETF exposure based on Canadian natural gas. It was kind of the Bitcoin of the time. And learned a lot of lessons about the ETF space and indexing and how a rules-based manager fit in that space. And we've now continued that with other strategies, more active strategies, more typical CTA-like, including managed futures strategies, as well as broad commodity strategies to compete with the GSCIs and the long-only BComs of the world. Continued to grow. We run right around 800 million in assets, a fair bit of growth in the last few years. Definitely see the environment we're in as a kind of a new paradigm, or back to an old paradigm. We don't really view the volatility we're seeing as outlandish or crazy, but maybe more back to normal, what we saw for the first 10, 15 years of our career. So kind of doing what we do, not much different, and it's an opportune environment. It's an exciting one.
Awesome. And just quickly, because I always find it super interesting, touch on what you were doing at Shell. Were you slinging around hundreds of millions of barrels of oil and derivatives?
So my part of Shell was almost, just think of it being the CTA, being the non-correlation focused on energies, but going about those markets or trading those markets in a way different from a large part of the trading team, which was physical and fundamental. So Shell had assets, whether it's pipeline rights, logistics, storage, and would trade around those assets, if you will, or that optionality. Our job was to go out and create exposure that was non-correlated. So trade those same energy markets, but do it in a non-correlated way that was accretive. So really the CTA philosophy. At the time, we didn't really know what a CTA was. We were quantitative, and trend following is where most managers go. We all want to follow trends, whether your driver is technical or fundamental. And so we were to provide that non-correlation. A lot of it was focused on obviously the energies, but again, natural gas really was the proving ground, not only at Shell, but early formative years of my career at TD Bank, in that natural gas teaches you a lot about risk, a lot about how to capture trends because they change very quickly in that heretic commodity. And that really became the basis for what our systematic rules-based approach still is today, has become.
And you mentioned you guys had that white paper a little while ago talking about this new kind of, or as we said, a return to normal commodity volatility environment. Can you dig into that a little bit more and what you guys found there?
Yeah, well, so from a commodity perspective, I think we're back to something that's normal. If you look back, many years, it could be everything from interest rates to inflation to just the overall volatility level. There was a lot of opportunities, and then when we went through this period that was post-financial crisis, that was really driven by quantitative easing, and kind of what we view as a bit of an artificial environment. The question is, where are we going from here? And we think, we're back to sort of that more normal state. We're going to have the odd chaotic event. COVID for sure, started that way. It moderated fairly quickly. Russia, Ukraine, but these things happen. But when we look at the environment we're now, whether it's CPI, VIX, just overall volatility level and that opportunity set for CTAs, we think we're kind of back to a more normal environment, not that artificially compressed environment that we saw driven by quantitative easing in the financial crisis.
And that doesn't matter up or down. You're not saying we're back to this up market. Yep. It's just we're back to bigger ranges, more opportunity.
Yeah, exactly. And I think that's a super important point is because we're a commodity tilted CTA, and something I haven't mentioned, we run about 75% commodity risk, even in our diversified flagship CTA, which is different from many CTAs. It's not because we just believe in bullish commodity scenario. What we believe is that commodities are the most diverse asset class. They provide the most opportunity. They are a little bit more volatile typically. And cotton's not like crude's not like coffee's not like canola. And that's a great opportunity set. And we're back towards an environment where those up and down scenarios exist. Let's just go back 3 years. When this sort of regime shifted out of the low volatility, morose environment of a 2019, and that had continued into 2019 for many years, what happened? Well, we sold off. So it wasn't just because we were bullish commodities. In fact, we were bullish commodities overall, coming out of 2019, but that wasn't the opportunity. You had to be agnostic about it. The opportunity in Q1 of 2020 was to get short quickly, capture that opportunity, and flip around and wait for the next opportunity that happened to come along from the long side. But even just look in the last few months, that opportunity set has yet again flipped. So you're right. We are agnostic as to market. We're agnostic commodity or financial. We are tilted commodity, but we're definitely agnostic up or down.
This, as you just mentioned at the end of that, this past few months, right? Like there's most everything you would see on Twitter or in the press these days is cotton's down 40%, corn's down below
Sure.
where it was at the start of the war, all these
Yep.
negative headlines.
Sure.
You guys have held up well, right? You're not down 40% like some of these markets. How does that work of being able to capture the upside but mitigate the downside?
Yeah, I mean, it's funny. I've said to colleagues of mine that, I think we're a better short trader than we are a long trader in a lot of ways. I mean, trading from the long sides, it's going to sound a bit flippant, but is a little bit easier as a general progression. It's kind of like escalator up, but how can you capture that elevator down? That's the hard part of trading. But if we go back to those lessons learned at a conservative Canadian bank in TD and trading natural gas, we had to apply ourselves in a certain volatility window. We had to be able to capture those opportunities, and natural gas kind of taught you those lessons about what we call trend capturing versus trend following. And we've seen that a number of times in the last 3 years. We saw it Q1 of 2020. We saw it again here recently. Now, you're right. All of a sudden, the narrative in the media and everybody's flipped on, well, commodities is over. We think we're so far from that being a reality that it's not even funny. The thing about commodities that people don't seem to get is this isn't Bitcoin. This isn't ones and zeros. You can't flip the supply demand equation on a dime. You can't even flip it in a year or two. These are long-term cycles, and you're talking about an area that has been underinvested in for the better part of a decade. CapEx has been in decline since 2012 in oil and gas, mining, and other areas. So when you consider how challenging it is to invest in the commodity space, and for lots of reasons, we believe that paradigm is going to last for some time. But that, we've always said that does not mean it's going to be a one-way street. We're gonna see ups and downs, and that is the opportunity in commodities.
Yeah, it makes me think. I don't know if you read the letter of the Petroleum Refiners Association back to President Biden. Right, Biden said, "Hey guys, help us out," and the letter was basically, "Hey, we just saw California say no gas engines by 2030. We saw this national mandate. It cost us $100 million to build one of these refinery plants. Why would we invest in that when it's a 10-year project, when you're taking that away in 10 years?"
Yeah, and you're seeing that in the United States. You're seeing Europe's definitely feeling the effect of that philosophy that started earlier. And Canada, we're based and where we're from is the same, and I'd argue much worse. We've got a resource-based economy, as everybody kind of understands. Yet we've got a government that is fighting from a policy perspective to make it extremely difficult for the oil and gas space. Just recently, this last week, they've come out with some pending rules and legislation and policies around fertilizer use for farmers and capping the emissions and making it much more difficult for farmers who are supplying the world's grains. I mean, Canada's the largest supplier of canola.
Yeah, number 2 in wheat or something, right?
Yeah. So, I mean, it's, these governments want these narratives, and I think they want them because of political reasons, right? They want to win votes. Our leader surely does in many regards. Yet, same as that letter in the U.S., the suppliers and the people taking risk in this area saying, you're not making it any easier for us, yet you want your cake and you want to eat it too, and you want lower gas prices, yet you're making it very difficult for us. So this is an interesting point. These are the things we're fighting. And so when we look at commodity cycle drivers, and if I can I share a screen on this?
Yeah, go for it.
Talk about that. Let's just see if I can pull this off here. Shuffle a couple of things around.
Just while you're doing that, I'll just add, one thing that we find we're explaining a lot of times, commodity trading advisor, what is that? Historically, that registration and that name actually used to be very relevant. CTAs traded commodities. Commodities were a great opportunity set for a number of decades. When you look at the B Top 50 or benchmark, that annualized like 9% on 10 vol for, I think, 30 odd years until we hit QE. So this opportunity set within commodities historically has been the best. It's really only over the last decade that we kind of saw some of our peers, they move more into financials for, what at the time looked like good reasons, fixed income, equity, rate trends, commodities not doing well. But, what we're seeing since 2020 is really back, a step back to a more normal environment where we're getting volatility, we're getting moves on the upside, now on the downside as well. And as Tim mentioned, the opportunity set within commodities is just so much higher. The correlation between these markets is lower, the volatility is there, and it's a really great place to trade.
Yeah, so I haven't introduced Brennan. So Brennan Beznicki is our product specialist at Auspice. He comes from a great background in the CTA space, having allocated to CTAs from TRS Illinois and went on to Campbell and Company. Brings a great perspective. I'm just going to jump to this share screen. So, okay, so where are we? So yes, we had a bullish commodity market that started in arguably it started in late 2019. It was one of the biggest calls out of a number of banks and different analysts in 2019. We could see there was an underinvestment in supply. I'm going to flip back and just show you that. So this is CapEx on the left and right spending. On the right is oil and gas companies, and on the left is mining. And so you can see that peaking about 2012. So we've been in decline from a CapEx perspective, an investment in the underlying commodity supply for quite some time. And so that's existed for quite some time. And so where do we get to now? So we see two main drivers for a commodity super cycle. They are an extended period of underinvestment in supply, which we just illustrated with CapEx, and then some sort of generational demand shock. And of course, you immediately say, well, the demand shock is COVID. Well, it's not really COVID per se. It's what comes out of COVID. And so it's the things that cause you to do something different or act. And so what are those generational demand shocks? Well, it's this green transition, right? We want to build back better, but we want to do it better. That means we have to build. The first word's build. We got decarbonization, we got ESG and stakeholder capitalism. These things are inherently inflationary and put pressures on the commodity system. So that's kind of your catalyst to get going. And if we go around the wheel from the green bubble, what are the other things that we see? Well, we see supply chain complications. We see labor shortages, unionization, aging demographics. We, of course, saw the war between two powerhouses, and that continues. And by the way, we believe in that, that surely didn't start this party. It became sort of just another event, a very serious one. But what I believe it does is it elongates the problem. Then you've got the overall investment in commodities and inflation protection type products has been underinvested in. I mean, that's just plain and obvious that there's a lot of catch up to be had. I mean, we see a lot of pensions, that kind of come in the third or fourth or fifth inning of things as it gets processed that aren't even there yet. They're on their heels. You got rising interest rates. We'll talk about that in a second. You've got potentially the significant reopening of a top economic superpower in China. And then back to that underinvestment in supply, we've got government policies that are impeding resource development and progression. And then that decade, again, of underinvestment. So here we go around in these circles. When we look at all these factors, they are bullish. So what does the Fed do? The Fed says, well, we're going to raise interest rates. We're going to deal with consumer-driven inflation. And that's going to solve what? That's going to solve the commodity problem. It doesn't solve the commodity problem. In fact, we argue that raising interest rates can, yes, it can reduce demand for manufactured goods, but it surely doesn't increase short-term commodity supply. It surely doesn't incentivize long-term commodity infrastructure investments. It likely doesn't increase labor related issues or improve them, aging demographics, supply chain, and surely doesn't resolve pandemics and wars. So perhaps even raising interest rate exacerbates the problem. Yes, it can deal with, you and me if we get in our vehicles and if we spend money at Walmart, and we're seeing the effects of those things. But long term, we think that setup's there. But what I want to make clear to people is we don't think that's an escalator. We don't think that's one dimensional. We're just going to go up. We're going to have ups and downs. And those down moves are going to be largely, aggressive and violent. And so can you find a manager that is good at capturing that downside flush? That's where we think we have a particular edge, which we're welcome to talk about.
A few thoughts are, one, right? People still got to eat. So right, I wish if you raised interest rates, I could lose a few pounds, make
Right.
me eat less, but I don't think it's going to happen. Talk a little bit about, right, if I'm sitting at a endowment or institution, I'm like, yeah, I get all this. I love this. I agree with all this. That's why I'm going to do 5% in commodities, right? Just a passive 5% in commodities in like the Goldman commodity index or something. So talk a little bit about how that differs from what you're doing. It seems obvious on its face to me, but just in case others are making that decision in their portfolios of like, why not just have a standalone active long only commodity allocation?
Well, so you said some interesting things there. A standard active long only commodity allocation. So there's a pretty big trigger there, and that is active versus
I think I meant to say
passive.
standalone. Yeah, standalone.
And so there's the door open. I'm going to walk through it. So yeah, okay. So largely commodities have been taken out of portfolios, and I'm going to definitely separate resource equity and commodities. They're different. So let's just put that aside. You can read research on that. We've got it on our website. But let's talk about how to get that exposure. Long only is one way. And so you go buy the GSCI or the BCOM related products, even find one with a little twist in there. But generally you're just long only. You're hoping it rises. And it may. And if you look over the last 2.5, 3 years, I mean, there's been quite a run in commodities, and GSCI is up whatever number it is. But it's about your investment experience or your client investment experience during that time. And, these are products that trade anywhere from 18 to 30% vol. They have massive drawdowns. Even, in the last couple of years, the GSCI and BCOM have pulled back, 50+%. Could you apply principles from the CTA space, i.e. trend following, volatility-based position management, term structure, that give you a better experience in that upside? So if we just said we want commodity upside, instead of just being passive, could we be active? And what are those things we could do? Well, we know trend following and commodities are the two of the key things in terms of fighting inflation. So how do those blend in? So our approach, and we've got a number of products, but one is Auspice Broad Commodity, where we look at a commodity basket. We look at each commodity on its merits, i.e. is it going up or is it going down? And then apply CTA-based sizing and resizing and risk principles to that. And what comes out in the wash is a much better client experience, whether it's a retail client or a institutional client. And we all want that upside, right? Like, it's been a big rally in commodities to start this year, and maybe our product didn't keep up with the GSCIs for that period. But then you get the flush, and it's giving back far less because we're cutting risk, getting out of positions, going from long to flat in that particular product. So again, chasing returns and making yourself feel good for a period is one way. But if you accept that maybe long term there is a spot for commodities to fight inflation, it's surely understood as one of the best ways to get it. And then you apply these principles that we use as CTAs in terms of risk discipline. I think there's the opportunity for a far better client experience. And I think that's what we're experiencing is clients are gravitating to these tactical active strategies that still give you the commodity upside, but do it in a far more risk responsible way that's a better client experience.
And I pulled up while you were talking there your slide on the upside performance versus the downside performance. So you can capturing most of the upside and avoiding, that, if not
that's
profiting
exactly
from
right.
the downside.
That's right. So thank you for doing that. So this is, it's basically looking at the BCOM as a benchmark in the commodity space. Let's look back at those periods when that rallies. And how has Auspice diversified, being this 75% commodity tilted CTA? Can it get that upside? Well, you can see in that first section that it can, fairly highly correlated in those periods in the past, and captures a lot of that upside. But the question is, when those things flush, and they will, most recently in the middle section, Q1 of 2020, you saw BCOM drop, almost 25%. Auspice Diversified flipped around and went short and gave you a gain. and yet still participates in that commodity cycle full term. And I can tell you it's not in this slide, but if you even be more aggressive about it and say, how has the GSCI done since Jan of 2020? And how has, Auspice Broad Commodity done, or long flat, or how has Auspice Diversified done? We've outperformed it with a fraction of the vol and the fraction of the drawdown. So you're getting that upside, but you're doing it in a much more controlled way. And to impress upon back to the point way back, is it just because we're gathering commodity upside, is that the only game that we bring to the table? No, we think there's so much more to the commodity side, and that's trading both ways.
And you mentioned a few times the model and the risk control, and just if you could give a quick example of how that works, because a lot of people be scared, oh, this is some crazy black box algorithmic something or other. my quick example would be, right, if you just put a simple 100-day moving average and the price goes below that, you get out, would be the very simple example.
Yeah, I mean, so there's a bunch of ways to do it. So first of all, like point blank, I mean, we're rules-based managers for lots of reasons. One is for consistency. The way that natural gas is behaving is different than the way corn is behaving, is very different than the way the Swiss franc is behaving. And so being consistent in that application is key. One, because we're all emotional human beings, and we're going to react to things, and we're going to do the wrong thing at the wrong time. And so for sure we're rules based, but that's the edge. Now, does that mean that we put our head in the sand and just hope what we've built and curve fitted in the past works out in the future? This is where we believe that we have a particular edge at Auspice. And that is this: we've developed strategies, and it goes back to those natural gas days, that adapt to the market environment. So I'll give you an example. So you look at something like a breakout above previous highs to indicate momentum. It's just one thing, so take it with a grain of salt. But you look back and you say, well, we're breaking out from previous highs. Well, how far do you look back to define a previous high? Do you look back 2 days, 2 weeks, 2 months, 2 years? Well, what we believe is it depends. It depends on how volatile that commodity is. So let's say natural gas is in a low vol state. It's not moving around much. Looking back too far back really tells you nothing about a more significant recent breakout that's going to tell you something about current momentum. You don't need to look as far back. But if natural gas is super volatile, looking back only 2 days isn't going to tell you much about a significant breakout or qualifying your trend. And so what we do is we look at a robust universe level parameterization where we look at breakouts across all assets. What's a good spot that indicates momentum up in a breakout from previous highs, and set goalposts? And now the strategy can find its way between those goalposts, between looking back a short period of time and looking back a longer period of time, based on the characteristics of the volatility of that particular asset at that time. So this is accomplishing a number of very important things. One, you're adapting to the volatility regime of that particular asset at that moment in time. Number two, by saying it doesn't have to be some particular number. Our look back period's 30 days. That's the magic number. That's the curve fitted number. That's going to work perfectly for ever more in future. I mean, that's curve fitting, and that's not robust. So we're allowing it to range between these results. So that introduces a robustness. Then the third benefit is that same parameterization that's universe level across all assets, forgetting energies or commodities, all assets we can find in the world, and saying this is a nice sweet spot. That allows the strategy to be applicable across all assets and all different markets. And so when you put all those together, that's what we discovered worked really well with natural gas. And that's what, that's ultimately why we left Shell to start Auspice, is we felt what we had done and our research had led us to survive the heretic volatility and capturing trends in natural gas was applicable in all assets.
I'm going to move off commodities for a second and talk through that other 25%, and kind of what I was alluding to before, right? Of commodities, I think Bloomberg index was down 10% in June or something. I believe you guys were slightly up in the Auspice Diversified program. So how is basically the question. I know the answer, but right? Because you're short bonds, you're short foreign currencies, you have all these other complementary trades. So just talk through the portfolio level, that other 25% for a second.
Yeah, so for sure, why do we even include the financial markets, whether it's bonds, currencies, or equity indices? Because they're incredible diversifiers. They're unrelated to what's going on in the commodity space. And remember what the ultimate goal is: to provide a non-correlated return stream to what a client has in their portfolio, whether that's equities, fixed incomes, or other alternatives. You should ultimately be non-correlated to all of that if you've gone about this in an unbiased way. So what does that imply? That implies that at times we're going to capture those equity moves up or down, like in a year like 2022 or back in 2020. But maybe there's times when the only game in town is equities. So let's think back to 2019, that low vol, really tough environment for CTAs. There's not much trending going on, save for equities grinding higher. In that case, we're going to have a little bit less equity exposure than a lot of other CTAs. And so maybe we are going to underperform a little bit. And we did a little bit in a 2019. But is that when you needed me to kick in and help your portfolio? Was that the time, or was it Q1 of 2020? And so I think there's a fairly obvious answer there, in that most portfolios did pretty good in 2019 because they had a lot of equity exposure. Even the alternatives they had a high equity beta, and they felt maybe they didn't need inflation protection. What value were commodities giving? They weren't moving much. But it's finding that balance between the areas. So, if you look back historically, did we make all our money in just commodities? The answer is no. We find incredible opportunities in those financial markets. Look here recently. I mean, currencies have been pretty sleepy for a long time, but look at the opportunities we're seeing in currencies right now. So again, we're agnostic. We're a commodity tilted manager. Yes, we have a big background in commodities, and we see a massive opportunity there. But we're not going to put our head in the sand and say that's the only game in town.
Yeah, and I personally, right? Well, I'm personally invested in a lot of trend following. So to me, I could spend years researching the euro, right, versus the dollar, and when I should go long or when I should go short, and probably spend a lot of money, versus most every trend following program caught, right? The euro went down par with the dollar,
right?
Which 10 years ago people would have thought was ludicrous. But here we are, and there's no magic bullet. You didn't sit there in your lake house cabin there, which looks beautiful, and say, oh, I think the euro's going to 90 cents on the dollar. It just, the models captured the downtrend and you got involved.
It's that agnostic word. I mean, you have to take what's happening as the reality. And I'll give you another perfect example of this: the idea that the US dollar has to be weak or weakening for commodities to rally. I mean, we've heard this over and over again for years and years. It seems like my whole career. There's so little basis for it. And if you adhered to that, you would have missed a lot of this opportunity, because the US dollar is bloody strong and doesn't seem to be getting much weaker either. And so, there's other factors at play. Why not just say, you know what, we don't know. We don't have crystal balls. Our job is to follow trends, capture trends, and manage risk. And if you stick to that, I think you're going to be very effective. Now, you can't always just be a pig at the trough either. We believe, and it's going to be different philosophy than other CTAs and many that you've had on here, that eventually the risk reward changes. When the volatility gets to a certain level and you've got mark-to-market gains in a trade, the probability of keeping those mark-to-market gains is diminishing. It's just math. Mm-hmm. And so, the traditional philosophy is ride that out and, never take your foot off the gas. We disagree. We believe there's a discipline there to capturing trends when the risk reward changes. And the proof's in the pudding. If you look at the big crisis alpha, crisis events, the big flushes, whether financial crisis back in volatility in 2014, 2015, the end of 2018 when everything flushed, 2020, Q1, 2022, we've never missed, right? And it's adhering to that discipline.
It's pulled up. I think this is the slide that goes with that concept, which I also like because it is showing that you trade carbon emissions, which is another cool thing.
Yeah, it was one of our best markets last year. It's obviously one of our newer markets that we've added. But this talks about that volatility adaptive process in some great detail here. Starting at the bottom, number one, it's a lower volatility environment. We're looking for a breakout from previous highs. Again, one qualifier, take it as just one piece of the puzzle. You don't need to look as far back. And then things explode higher and things get much more volatile. Well, so now you're looking further back to qualify a breakout, either on the upside, which is the way we're going, or on the downside. Well, what is going to take you out of that trade? For us, it's that point number 3. We call it a volatility stop, where we're exiting risk or cutting a position completely because that risk reward has changed too great, too far. And the probability of keeping those gains has diminished. But we may re-enter that market, but we're going to, again, adjust our position sizing based on that. It also allows us to flip around and flip from long to short quicker. And so, we believe this agility is part of the edge in these opportune volatile times, which are akin to a lot of the times in commodities in general, right? So, quieter in the financial markets in general, but you want to capture those opportunities, more volatile in the commodity markets in general. And that's where we started this philosophy, and it works really well across, really all assets.
And then had a question in the chat here of how do you approach, like you added the carbon market, how do you approach that? Is there a certain level of volume or liquidity that's needed?
Yeah. So it's a great question. I mean, we'd love to add, everything. We don't adhere to the philosophy that you hear a lot in the CTA space, that we should be trading 250 markets. We don't believe there's 250 markets to trade. We believe, it's the philosophy of adding that one extra thing. It's diminishing value add, right? So, if we added, pick a market, we add Bitcoin, yes, it may be opportune, but it's one of many, many things we trade on a fixed fractional basis. It's not going to change the world. It's just another opportunity. So yes, we're looking for those opportunities, but why would you trade many, many more markets? Well, capacity issues, those are some of the key things. What are we looking for? Yes, liquidity. We have an approach that is fairly agile. So we need liquidity. We don't want to slip too much. Is it highly slippage sensitive? No, because we're not a short-term trader. But execution in and out means a lot, especially if you're trying to capture trends at these key volatile times. It makes a difference. So yeah, certain markets adhere to that and fit in that philosophy. You don't want big gaps in markets. So you don't want markets that you wake up and you've blown through stops and that keeps happening. Could help you, but oftentimes it doesn't. So it has to fit certain criteria for us. Always looking to expand, and we'll continue to do so. Carbon is a perfect example of that.
Yeah, just two quick further comments to that. I mean, we're very focused on maintaining the crisis alpha reliability of diversified. We can basically, shut down our portfolio in a matter of minutes. So liquidity needs to be there. We need to be able to get out of markets, very quickly. And then second, I think where we differentiate is we're really trying to give meaningful exposure to a lot of these core markets. So I'm just looking at our attribution from last year. November, carbon was our biggest winner. October, zinc. December, soybean meal. A lot of these things are markets that other CTAs trade, but in very small allocations. They won't come up in any meaningful attribution. This is where we really differentiate. We're giving meaningful exposure to a lot of these markets that most investors don't have in their portfolios.
I think that's a good point. Like we used to, back in the day, AQR's managed futures program was 14 billion, maybe it got to.
Right.
And just at that level, they physically can't put on enough corn futures.
100%.
No, well, that's it. And so we are in a sweet spot, we believe, Jeff, in that, we're growing, but we've got a lot of capacity, and we've been at, Ken and I've ran much larger portfolios in our career institutionally. I think we have a fairly good feel for where we can get to, but we don't have an illusion that we're trying to get to the AQR level and be as effective as we are in capturing trends. That's not the goal here. The goal is to get to a different level, but do it providing the same value that we have for the last 15, 16 years.
Yeah, and I think you can see right there, not to pile on, but their performance and their assets have flowed out because they just couldn't do it at
It's very tough.
larger level.
Yeah. And they're another, they're one example. We've heard that same story out of peers we have at other big brands. I don't like to name the names, but half the battle is, okay, what do we do with this pile of money, and how do we be anywhere near as effective, and how do we execute properly, with this much exposure? Well, you can get cute with things like with swaps and all sorts of things. And Ken and I have a ton of experience in that area because we were so big at Shell that used every tool in the toolbox. We ran a lot more vol as well, but again, we think there's a lot of growth to the to where we are right now, but it ain't infinite.
And then you mentioned, I'm just going to share something real quick here. You mentioned the crisis period performance.
Yep.
So here on the bottom left here, performance when you need it
Mhm.
most. And this is a classic trend following type profile, right? Of they do well in extreme events. So just talk through a little bit of that. That's not on purpose. You're not predicting those events. That's just how.
No, I mean, and look, I mean, by talking about crisis alpha, and it feels like that's all CTAs have talked about for the last better part of a decade is crisis alpha, because there wasn't many other opportunities.
Right, and to Tim's credit, he was always saying, "Hey, don't forget about commodities." Well, everyone else had pivoted.
That's exactly where I was going with it. Is crisis alpha is fantastic, and there has been another opportunity to develop here the last 3 years. But in the meantime, there's been two incredible crisis alpha opportunities beginning of 2020 and here in 2022. And so we're kind of coining this one. We've kind of flipped what we called this year already. We called it the commodity crisis because it became this big boom in commodities in Q1, exacerbated by Russia, Ukraine. So that was one set of opportunities. But at the end of the day, really, what is this? This is the big wake up call that we've kind of as alt managers and CTAs been warning about, and that's a 60-40 crisis or whatever way you want to describe that. But your bond allocation didn't work, your gold allocation didn't work. Hopefully you had enough tips on, you didn't, so that didn't work very well. And other tricky things to put on in the portfolio, those just didn't help much this year. What helped? CTAs helped. And especially commodity tilted CTAs, and especially commodity tilted CTAs who could flip around and get short fast enough.
And talk through that. That was one of the questions here. Do you view this as an inflation hedge?
Well, it's proven itself as a fairly good inflation hedge. Yes. So there's a couple things. One, commodities are, and two, trend following is. And so when you combine those things, they end up being a great inflation hedge. And actually, you did a great job in bringing up that upside commodity participation slide a number of minutes ago. We have a number of products that fit into this category. Some of them are long only or long flat commodities, and some are long short, like Auspice Diversified or Flagship. And what they've illustrated is they are very good inflation hedges if you can capture that commodity upside, and then you have that added benefit of the crisis alpha on the downside. So yes, CTAs can be a good inflation hedge, but not all CTAs are painted with the same brush. We've seen a lot of CTAs struggle that are financially tilted, a number of different tilts in their portfolio, and they just haven't participated, or they did participate, but then commodities turned around and they gave it all back, like you started this conversation with. Yeah. And so it's finding that sweet spot. There's no perfect answer. There's definitely value in CTA diversification. What I argue is just we're kind of built for this.
And to me, if you have gold, you have commodities, you have foreign currency, right? You have things that will act as an inflation hedge in the portfolio that will only kick in when they're needed to kick in.
Well, exactly. And, so this is one of the things, like, what's going to be that inflation hedge? I mean, gold gets talked about all the time. Gold isn't an inflation hedge. Gold is a statistical diversifier. I mean, you can pick some times when it, is coincidentally rose, or maybe it rose for a period of time. Think of coming out of the COVID shock, and what was the first commodity that started to move again? It was gold. and we got long. That was the first thing we added back to our long flat strategy was gold. But by September, it was out the door because it wasn't going anywhere. And it was those other commodities that started to kick in the summer of 2020 and provide commodity upside. So if you only relied on gold, or if you only relied on oil, that ends up being an unideal experience.
We got a slide for that.
Can you go to slide? I just want to cover the crisis alpha comment a little bit further. Can you go to slide 19? I think that's so the crisis alpha. So Tim kind of gave me a little bit of background at the beginning. I was at Campbell and Company for a while. I actually led Illinois teachers' investments into CTAs 2013 to 2016. This idea of crisis alpha, it's definitely one of the core parts of most CTAs, Auspice Diversified. Definitely, it's something that we've outperformed in. But this concept is really only a concept of the last decade. If we go back post 2010, crisis alpha wasn't even a term back then. CTAs historically still were uncorrelated, but very much used as a return enhancer, standalone absolute return strategy. It was really just this last decade, post QE, inflation essentially at record lows, interest rates, at zero, volatility low, that this, concept of crisis alpha is what drove a lot of investment in CTAs. You had a lot of the biggest pensions look at CTAs and say basically, what, if we only get this crisis alpha from a CTA, that is very accretive. And they kind of handicapped it to that, saying, if we lower the bar and say that's the expectation, even in that case, it's still very powerful. And they created these, crisis risk offset or risk mitigation portfolios. So that's great. But what we've seen since 2020 is arguably returned to a much normal environment. The returns are a lot more consistent. We have long trades, we have short trades, we have volatility back at normal levels. Like the environment that we're in today isn't abnormal. Arguably, it was really that last decade that was abnormal and that really compressed returns. So like crisis alpha is definitely core to the CTA story, but there's a lot more than just crisis alpha. And that's kind of what I think people are being reminded of today.
And just to finish up on that, but that is not going to fit for a lot of CTAs because a lot of CTAs tuned themselves to that QE environment and financially tilted and adjusted a lot of what they did in their portfolios and even the trend following approach that they took. And you've seen them struggle. You've really seen them struggle in this past 3 years, and they can come up with all sorts of excuses. But the reality is they went and chased returns and money flowed in. We never deviated. And so, we got to bear that cross. That cross is that, at times we did underperform. But, how much? Like a tough year for us. I always say the tough year was 2019 because there's just nothing going on. I think we were down 6 or 7. And so we were a little paper cut in the portfolio, but we showed up when we needed to. 2020, Q1, the rest of 2020, 2021, 2022. And if we are in a more normal environment, we're excited about that going forward. Nobody has a crystal ball, but I think we're in the right place.
Right. And that, just to put a point on that, to me, those other CTAs, they added long equities, they added a long tilt, they added more financials, as you said. But speak to that, because it's not the case that if the equity market rallies sharply higher, you're going to lose money like 19, right? It was not a function of equities going higher. It was
Correct.
A function of very low volatility across many, many asset classes.
We were long equities. Equities, as a whole can be about 15-20% of our portfolio. We were long equities. The challenge was that nothing else was going on, right?
Yeah.
So summer of 2020, we had a little bit of excitement. If you remember, we had the yield curve inversion in August of 2019. Nothing else happened that year, but that was an exciting moment because the yield curve inverted and equities dropped and CTAs actually popped the other way in general. And put up a positive result when we had this sort of shocking August 2019 month. I think we were up 10% that month. And so it's not that we weren't in the equity space, it's that there wasn't much else going on. And so if you were totally equity tilted, you outperformed. If you were tilted to anything else but equities, you underperformed to some degree. And so, that's a trade-off. That's a decision we've made in terms of what our opportunity set is. We believe, just this bit more volatility. We're not talking chaos of Russia, Ukraine. Just this bit more volatility expands our, punch bowl of opportunities exponentially.
Yeah. And I would call it not even volatility per se, but dispersion, right? Like if cotton's starting to do its own thing, if crude oil is doing its own thing, like these supply chain issues have really opened all that up. Exactly. Of like, hey, it's not all dependent on the Fed. Like there's actual real world things that are going on.
So that's back to that commodity slide I showed and talked about the super cycle, but all those nodes around that, that super cycle potential speak to that, labor issues in, Colombia to do with coffee planting, like the list goes on and on and on and on. And these are very real things. Well, now we got like Canada is the largest supplier of canola in the world, and our federal government's pressuring us not to use as much fertilizer, or severely handicap the farmers. Like it's asinine, but that's the reality, and this keeps happening commodity by commodity.
Well, that's too deep. Anyone have any further questions there? I was just going to say, like, why did the market care only about the Fed for those, right? 16, 17, 18, or 17 through 19. And now
because it was because they're a powerful tool, they're a powerful machine with powerful tools and with the ability to, go further and farther and deeper and, than most people maybe expected. So you can't ignore the Fed, but you got to be realistic about what they're going to do here. Is the Fed raising rates going to fix the commodity problem? That's a really easy answer. And anybody who thinks that's the case has been fed, a bunch of media garbage. That is not going to fix the problem.
Yeah. Just to bring it home here to Canada, we had some inflation data come out last week. And I'm just going to read you a couple things. So the return of sporting events, festivals, and other in-demand gatherings has resulted in higher demand for accommodation. So prices for accommodation rose about 50% from a year ago. So in that case, that may be an example of, raising rates might affect that element of inflation. In the same article, they have a big table with a bunch of basic food items and the year-over-year increase. So onions, 25% up from last year. Carrots, 23%. Chicken breasts, 20%. Cereal, 18%. Raising rates isn't going to affect any of that. So it might affect, elements of our discretionary spending, but the underlying commodity shortages that are, a result of a decade plus of underinvestment, raising rates isn't going to affect that. If not, it's going to make it worse.
I think so. Again, but please don't get the impression that I'm just calling a commodity bull run. It's going to go one way, 45-degree. We're getting that schooled right now. That's not what we said. We think there's a bigger opportunity, but you better buckle in for it, and you better have a manager that can participate in it in a risk-responsible way.
And Brandon, we had one here for you. When you were working with those institutional investors, where would they put a program like this into their what allocation bucket would it go into?
Sure. Well, I can give you a couple answers to that. Illinois teachers, so historically, like a lot of institutional investors, they got their kind of diversifying strategies through fund of funds. That proved to be largely ineffective. My role was to essentially liquidate those and introduce real diversification. So CTAs went in the quote unquote diversifying strategies portfolio. Other pensions have created these very specific, what's called crisis risk offset or risk mitigating portfolios. And then more recently, I think we're seeing CTAs being used a lot just broadly, whether it's inflation protection, commodities. If you're a commodity focused CTA like us, there's a much larger role. So I think historically it was very much focused on, the diversification element. Today, arguably a larger role. So I don't know if that answers your question. Hopefully it gives you some perspective.
Yeah, definitely. And to me, it's like this, are you talking to a lot of investors that are saying, hey, my 60-40, I'd rather have part of that 40 be this?
Yeah, 100%. Like we've seen, so someone like Ontario Teachers, for example, their fixed income was, I think, cut in half over the last year or 2 years, and commodity derivatives, internal CTA strategies are, I think, can't remember, it's like 20% of their portfolio right now. So, historically fixed income, you had your yield, that was part of it, but also your diversification. That fails in an inflationary regime. So we've seen that this year. You've seen that throughout history. That low to negative correlation that you get from bonds and equities, that fails in a rising rate environment. So a lot of people are moving away from fixed income and potentially literally, taking money from fixed income allocations and putting it in CTAs. Obviously, they're different in a lot of regards, but in terms of diversification benefits, similar role.
I'll just one last thing and we'll end the call here. And that is what Brennan described in the institutional side. And that movement towards product like these and taking down fixed income and this type of philosophy, we are absolutely seeing that in the RIA space, 100%. Sophisticated RIAs act like institutions, and that's what they're doing, is they're looking for products like these. We hope to win some of that business, but that's what they're looking for, 100%.
Love it. All right. Well, thank you, Tim. Thank you, Brennan.
Thank you.
Have a great summer up there in Calgary. Is the rodeo over? The Stampede?
Yeah, the Stampede was kind of the first week and a half, first 2 weeks of July. And we've got finally some beautiful summer has hit. We've had weather in the high 90s here in southeastern British Columbia. So it's been quite beautiful.
Awesome. Thanks again for everyone.
Thanks for the opportunity.
Just a final note for anyone who needs any further information, our website, we put a ton of resources there. We have explainer videos, our research is on our homepage, ton of stuff that we put up there. So check that out. You can email us directly, email RCM for fund specifics. And yeah, any questions, don't hesitate.
Sounds great. Thank you,
Thanks,
guys.
everyone.
Have a great day.
Summer. Bye-bye.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.